Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn with Focus Compounding, on air live with Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. This is the first time you're tuning in with us. Thank you so much for joining us. Be sure to check out all of our content that we push out into the investing universe. The best way to do that is to follow me on X at Focused Compound. Be sure to hit that subscribe button wherever you're listening or watching us here today. And of course, if you're interested in learning about our money management services, where Geoff Gannon is the portfolio manager, you can reach out to me at andrew@focusedcompounding.com. So Geoff, how's everything going in your world? How's everything going in your neck of the woods?
Good.
Did you see that the Skydance Paramount merger is finally happening? I mean, how many times have we gone back and forth with this? I mean, I love it too when stuff like this comes out on a Sunday, because I just think about all of the work that all these people had to have been doing, through the process. I think it came out last night, I was just like, oh yeah, they've been doing this, but it's like, there's been so much back and forth, deals done, deals not done. What did they say last time? Skydance. Did they say something last time? It wasn't because of financial negotiations. It broke down, but Correct. It was not because of that, right?
Yeah, which means people issues usually, like who's going to be the boss and stuff. And they have an office of the CEO, which is like 3 people. Actually, my mom worked at a company where she was part of the office of the CEO. That was 3 people. It happens when you can't agree on things. In that case, it was a family thing, right? So you have non-family members and family members, so you got to do that. But in this case, it was the heads of different things that they didn't choose a new full-time CEO. But this is basically, from what I read, and this is recent, so I don't know all the details. It's basically them buying National Amusements, right? So the major shareholder of the voting shares in Paramount. And there, as you see there, it says it gives them an enterprise value of $2.4 billion. Well, that's actually not that huge compared to Paramount's enterprise value. But it's all the voting shares, because this company has no votes at all on the shares that trade publicly. So this is a controlling stake in it. So we'll see. It would mean that the end of the Redstone era. This is obviously Sherry Redstone, not Sumner, obviously, who's the one who kind of put it together. But then it also mentions at the end that there was interest from different people, including Barry Diller. Barry Diller once tried to take over Paramount and fought Redstone over and stuff. And obviously he has plenty of money to do that now too. So I don't know if it means the end for actually Paramount, but it does give the control over to Skydance.
Mm-hmm. Yeah, it includes a 45-day go shop period. So I was wondering, I'm like, is there going to be other deals that come through from this? Is there going to be other offers? I mean, and, or is this really the end of this whole saga?
Well, I mean, I was involved in a situation where there was a go shop for the company, but there was someone who had almost all the votes and said, I can buy it or no one can buy it, So I don't know how realistic that is, right? Because it's a go shop, as I understand that, it's a go shop for Paramount, the special committee of the Paramount board, not for National Amusements. So National Amusements has all the votes, right? So to approve any deal that you do, you need all the National Amusements to vote for it. It doesn't matter what anyone else thinks. So, but it fell apart once before, so of course it can fall apart again. And Skydance is already a partner with Paramount, doing lots of production things. You've seen their logo probably on lots of their vanity plate on plenty of movies that Paramount makes now. So not a surprise that it would be them.
Well, the catchphrase, they said it's not just a catchphrase, that it's a new Paramount. It's not just a catchphrase. So what do you think is the future for this company going forward?
Break it up and sell off the pieces.
Yeah.
I think Skydance is interested. I think Skydance would be interested that it's cheap, and that Skydance is interested in the movie studio, which doesn't have a great slate coming up. It's weak. But the company owns some properties. It still distributes some valuable movie properties, or movie properties that have been valuable in the past. And it could be a good place to produce movies and sell them through it. So the movie studio is quite cheap if you sell off the other parts to different buyers. There's private equity interested in some things, we saw that Sony bought Alamo Drafthouse. So you had the first one since the Paramount decision where someone directly bought a theater chain. It's a small theater chain to probably just drive the specialty business for Sony, so maybe Sony Pictures Classics or something, things like that run through it. I bet it's probably like anime and things like that. Sony, I think, distributes some anime that's been big in the US. So those kinds of things, non-traditional and whatever, probably to showcase that more, get more data directly on the audience and everything and use it that way. The company franchises some of their locations and then owns other ones. I don't know if they own like 30 and franchise 20 or something in that neighborhood. They're not, what do we think they are? The 7th biggest circuit? I don't know, something around that neighborhood. I have to think through to name all of them, which ones are the biggest, but they're not that big. Mm-hmm. Yeah. And a bunch of them shut down in around Dallas, Yeah. Those were all franchised though. So there could be different buyers for different parts of it is all that I mean. So you have like CBS and you have Showtime and you have a kids TV channel that's really big. You had bids for Black Entertainment Television. So if you peel off all the pieces and sell them off, you get a pretty good valuation. Some of it is regulatory things and public stuff if they won't complain. But I think something like CBS, it's not that well, like it's not thought of as much of a competitive threat anymore. It sounds like it's older and everything. And so I don't know that there'd be political opposition to that as long as it's not sold to any big tech company. I think as long as you avoid selling things to the big tech companies. Mm-hmm. Paramount Plus could partner with someone or sell to someone as long as it's not Apple, probably. Mm-hmm. Maybe Warner Brothers is a problem just because they own CNN, and so there's a political angle to there. I think you could still get a deal through, but you would have bad headlines because, there's an angle to their political coverage or something, and that upsets people sometimes, even though it has nothing to do with the parent company, right? But yeah, so I mean, in the past, it was hard to sell off these. It was they couldn't just buy the whole thing anymore. You can have someone come in and buy the whole thing. You have to figure that out, who wants what, and whether it would pass regulatory stuff. So, I think it could be done over time, and then they probably keep the movie studio, is my guess. I don't see what Skydance would be interested in it if not the movie studio.
Mm-hmm. What are your thoughts on Sony buying Alamo Drafthouse? We have not spoken about that on the podcast, but that's a pretty major breakthrough, right? I mean, first time, is it ever that a movie studio is purchasing
since 1947?
Basically, a theater
it's been
circuit?
Illegal. It's been illegal in the United States, because there was an agreement between. I mean, that's how we talked about this. But if you read the book on the history of ABC, the Leonard Goldenson book, he talks about that. It was created because Paramount had to split off the different parts of the business. The movie studio could no longer own the theater chains. Originally in the United States, there was vertical integration. And so the movie studios in the 40s and before that put out movies directly in their theaters. They knew that they could run it there. And so it was a very different business. And then the United States went in a certain direction that way, the same way they would later with TV production, where networks couldn't produce television for themselves. They had to buy it from someone else. Same thing happened with theaters. The U.S. was in media stuff generally against vertical integration of production and distribution. So this is the first time since then. We've had rumors about it, right? Amazon is a releasing studio. Mm-hmm. For instance, they own MGM and they release things under the name Amazon/MGM or something like that. Now I think they've integrated the two names. So if they were to buy like an AMC or something, and we know that they've sniffed around some things, that would be only possible because of the Paramount decision is no longer in force in the United States. It was overturned. So that was like 4 years ago or something, around COVID.
Close, yeah.
Yeah. So this is the first time since then. Yeah, it makes sense. I mean, if Sony wants to be in the business, and they do, to buy something like this, it's a pretty... I mean, the ones that would make sense, I think, are Alamo Drafthouse, sure. Maybe Reading, right? But it combines different things. But if Reading wanted to sell off just their U.S. cinemas business, because they're mostly a real estate company other than that, that makes sense. You get the art house stuff of the Angelica and all that. You also get some regional things in there, but that's the main one that you would have. You'd have an art house type distribution thing. And then it's a big step up to the others like Marcus and stuff. If you wanted a mainstream, whatever, want to be Marcus, but Marcus is a family-owned company. And then you've got the really big ones, which might be more for sale, your Cinemarks, your Regals, your AMCs, if you were willing to make an offer because they're publicly traded without big shareholders controlling them. But those are bigger things to swallow.
Is this the end of the whole movie theaters are dead argument? Because now you have studios, is that a pivot from that perspective that movie theaters are always going to be a huge part of movie distribution? I mean, I haven't really heard that movie theaters are dead in a couple of years now, but obviously through COVID, the whole talk was to streaming and, who needs to go to movie theaters and the theatrical window. And it really seems like now the whole industry is much more cooperative.
Yeah, well, remember, Sony doesn't have a streamer. Right.
Correct.
So that's the difference. Sony is the one company without it. Lots of others of the big studios have ones that don't make any money. Almost all of them have ones that don't make any money. But Sony is the one that sells to the other studios afterwards in the aftermarket instead of to other studio streamers instead of having one themselves. They I guess technically had one at one time. Sony may have owned Crackle. I don't remember. But I think for the smaller movies that they're probably putting out in like an Alamo Drafthouse, you can increase the value of the movie by putting it out that way. Like, so for instance, this weekend, right? There's a movie that came out, probably made six and a half million. I don't know, Maxine.
Yep.
So that's an A24 movie, right? That benefits a lot by running in theaters first. Now it's going to make a lot of your money on PVOD. It's a horror movie. It's a period piece. It's the third in the series. That will make all its money and everything on like PVOD and on that kind of thing. But it gets so much more publicity by running it in studios first. And that's like the A24 model. Their movies, with few exceptions, they did do a few bigger ones. I guess Everything Everywhere All at Once was an A24, and certainly Civil War this year was. Those would have been bigger movies that made bunches of money at the box office too. But mostly they just get a lot of publicity for them, reviews and everything, and more critical praise by going out in theaters, and then you make your money on streaming and everything. We just don't know about that. But for those things, it plays a lot better to have had it come out in theaters. And you maximize the value of the movie over time if you do that, because it serves as marketing, right?
Mm-hmm.
So there's a lot that would benefit from that, from being run in theaters and then going in other one. I mean, Inside Out 2, I think, has a 100-day window planned, so it's not gonna go to Disney Plus until 100 days have passed. It's what is it in now? It's fourth weekend. I don't remember which weekend it's in, but yeah, it's fourth weekend. Yeah,
I saw it. It was pretty good. Yeah, I liked it.
So right now it's tracking ahead of Barbie, I should say. I don't think that it will probably finish ahead of Barbie just because there's more competition. But at this point in its run, it has made more money than Barbie. And if anything, it may have skewed a little bit younger, which would mean lower ticket prices if that's true. I don't know if that is true or not. But its attendance levels are probably similar to Barbie. At this point, if not a little ahead of it. I think it will probably not end up making as much money as Barbie when it's done in theaters, simply because there's so much more competition now. It's kind of like Maverick or something. Maverick made a lot of money, but it would have always opened big. But a month, 2 months into your run, usually there's a lot of competing movies, and there wasn't back then. Same sort of thing here. Like Inside Out dropped almost 50% this weekend, 40%. And that's purely because Despicable Me came out, right? So that took a bunch of its theaters and, took a lot of competition from that. And, whereas when Barbie was going, it had Oppenheimer and it had like nothing else in its category competing with it. So, but it could end up, Inside Out 2 could end up being as big as Barbie. And then it still gets on the streamer.
Why wouldn't they have released Despicable Me 4 like next weekend, for example? Like why release it so close to Inside Out?
Well, this is Inside Out's fourth weekend. They didn't think it would be this big. So,
yeah. I
mean, Inside Out is twice the size easily at this point, of any Pixar thing that's come out, or Pixar or Disney probably, that's come out since like COVID. So they wouldn't have realized that. And so they thought that it was a good spot. It's also, they probably wanted the 5-day weekend because the way the weekend fell this year, it's more beneficial. This is a 3-day that you're seeing that says, I don't know, 75 million or something. But that's pretty misleading because the other days are really, really big because they include, July 4th and everything. And so the actual amount that they made is pretty big. And, let's see, it says it'll do over 120 million for the 5-day.
Yeah.
Is that right?
Mm-hmm. It says 47.6 million was already earned from Wednesday and Thursday. And then it'll end the weekend total with over 120 million. Yeah.
Yeah. And that's the number that really matters, right? Because, people treat July 4th as if it's part of the weekend and everything. So from a calendar perspective, it was a very beneficial time to do it. Also, Despicable Me probably thought that they were on par or bigger than Inside Out 2 when they heard about it coming out. I mean, Inside Out 2 is bigger than Inside Out. Oh. So that doesn't happen a lot.
I was going to say, how does that happen?
Well, Pixar had a few where the sequels are bigger than the original. You have a few things. One is timing, right? So for a kids movie, right, in the past, maybe every 7th year, 6th year, you try to target like that because then everyone will have seen it, grown up on it, and then you can have it. So Toy Story kind of follows that pattern. If you can release something every, say, 5 to 7 years or something, then you would have you would make sure that everyone that watched the first one is now older but willing to watch this one because it's their childhood thing. And then everyone who's a young kid now has seen it, right? Because like Disney Plus there's no doubt that Disney Plus drives interest in Disney properties when they come out now, right? Like streaming, like Maxine is a good example of that for, other things, is that why is this one bigger than the other two in the series? It's because people have watched the other ones. Seeing the earlier ones on streaming helps it when it then comes out. So it builds awareness that way. And then there's just other things about it that's harder to say, kind of like what happened with Barbie and all of that. You have a traditional way that sequels are really successful, which is that it's the same stuff as before, but you introduce one new element that everyone wants to see. New villain, new whatever thing. In this case, it's new character, which is the face of it, which is anxiety. And that seems to be playing well culturally and everything with people, that maybe that's a feeling that they understand or they want to see or whatever. And so it's a good choice that way. So it feels different than the first one, but it's always hard to say, because I said Furiosa could have been big because Fury Road, was big. But it, like I said, it was like 10 years, and you don't know if it'll be bigger than the one before, and so it was terribly small compared to the one before. Yeah, it bombed, and it was very expensive to do. Now that one was also a prequel, which tend to do worse. But you don't always know if people know that going into it, whereas continuing the same story tends to do better. But that, so yeah, if it's really well liked, the first one gets good reviews and everything, then it tends to be that the second one will be bigger than the first one, especially if you give it enough time to play everywhere. But sometimes it's really long. This was actually a pretty big gap between the first and the second one. So sometimes it can be too long. And it's not always the case. There have been ones where the first one was really well liked and everything, and it didn't break out. I think DreamWorks had How to Train Your Dragon, which was a hit but not huge, and then like the second one didn't break out the way that this one did, even though the first one got all the critical praise and good audience reviews and all of that. So Disney also is better than anyone else at being able to have more places to show everything, have tons of merchandise. So the stuff has been on shirts and plushes and stuff for almost a decade in some of these cases, and able to do all that. It's generally more valuable for them than someone else. Like if Pixar kept doing Toy Stories, but they weren't owned by Disney, I don't think they'd be as big, because, like the Minions and everything, if it was owned by Disney instead of Universal, would probably be a bigger business, because they have a bigger consumer products division than Universal's capable of doing.
Is the bottom in? So you think about what has happened in the movie theater industry over the past handful of years. COVID, strikes, bankruptcies. Is the bottom in, you think, going forward? I mean, this is the box office was stacked the last half of the year, and we're in that, and things are starting to heat up. So curious to hear your thoughts. Is the bottom in? Cinemark has been ripping a pretty good amount. There's a lot of funds that are finally starting to buy into Cinemark, and I don't want to really talk about AMC because it's kind of a different situation, but is the bottom in for the movie theater and the box office?
Nope, because of the slate. So the problem is it's not as bad as last year, but bad is that it's clustered too much in a certain period of time and not spread out enough to have strong enough movies throughout. And if you look, a lot of these are family movies and horror movies, which have strong built-in audiences. What is a good sign is that they keep, not necessarily this week with what you're seeing with the projections versus predictions, but a lot of things are beating their tracking, which means that there's strong walk-up business. So people are coming later. Instead of buying their tickets ahead of time, which is helpful if you've seen a lot of trailers. So like people who are going to Inside Out are seeing trailers for things like Despicable Me and other things, and then eventually going and watching that movie, which is what you need to build up over time. But we have a few bigger movies possibly coming out. The one really big one is Deadpool and Wolverine, right?
Yeah.
So
a couple weeks, right? At the end of the month?
Yeah, at the end of the month. So that one is potentially very big. I don't know. Tracking this far out is very hard to tell, but it'll probably open to more than 100 million, less than 200 million. There's specific tracking on, I wouldn't want to.
That was 175 or something, right?
Yeah, projection. But that can drop off like you've seen some political things, right? Where they polled something and they thought they just had a French election where they had the order of all the parties completely wrong up until the vote. So, trust me, it can drop fast or rise fast, if you watch the tracking, it can move pretty quickly. But yeah, I think it's in that range. It would be amazing if it did more than 200 million or less than 100 million. Multiverse of Madness, I don't remember what that did, but that's one of the last big Marvel movies. And I think that's a pretty good comparable for it. It could break out even bigger than that, but I would say that Doctor Strange movie is a pretty good thing to comp against. It might have a longer and better run than that movie did, but it would make sense that it could open to a similar one. That's kind of our idea of what if there's a Marvel movie that everyone wants to see, what could it do? What that one opened to is probably kind of in line with what this could open to. There's a difference, though, with the rating and everything you have to keep in mind. So,
what do you mean by that?
So R-rated movies normally do much worse than PG-13 movies, yeah. So,
the movie I'm most excited for is Twisters.
I think that one could be.
I saw this movie growing up.
Twister
haunted me. Yeah, Twister haunted me growing up. Gave me bad dreams. So I'm excited to confront that haunting back to little child Andrew and see this movie. Production budget $200 million.
Yeah, that's insane.
They better do a lot.
That's
they better
insane.
do a lot.
Yeah, that's insane. You have a few things going for you on this one, right? So who knows what'll happen? But it could break out. But as you see,
that's crazy.
But what are the comparisons? The Numbers picks is one of the comparisons. Furiosa, right? That's the problem. So the big things that are possible here is they feature a lot in the trailer, maybe more than in the movie because I haven't seen the movie, so I don't know. Glenn Powell, an actor who's been in some things that would improve your odds of doing well at the movies now. So they have someone there that would help draw people into the movie. And then it's perfectly timed in terms of nostalgia and how far apart you are from when the original movie came out to what you're doing now. So, now is the time to do your 90s type nostalgia things, not your 70s and 80s and everything. So picking a movie that's of back then can be big. We saw that, it was, I don't remember 10 years ago or what, but when they rebooted the Jurassic Park stuff, and that was much bigger than people expected. So going back to things and it could. This is one that could be big, but it's always
you're spending
iffy.
$200 million. What's the projected opening weekend for something like this?
Well, but we could check the box office on this. What tends to be? Do we have? And for the franchise, I mean, do you have if it has it for the original one? See, the difference is we have to keep in mind that some of these movies play big in the rest of the world, even if they're not very good. And then others don't. So how much did Twister make in the rest of the world?
So their domestic box office was, and this is back to 1996,
right? Yeah.
241 million, and the worldwide box office 495 million.
Okay, so back then that's only fair. 50-50 split back then is only fair. I bet it could do even bigger that way. So as an example, one of the biggest Marvel movies probably in the United States, I would guess, excluding maybe the Avengers, certain Avengers titles, right, would be Black Panther, right? But Black Panther is not as big in the rest of the world, right? Like by the ratio of it. It's probably like a 1-to-1 ratio where it only makes as much in the rest of the world as it does here. James Bond makes several times more in the rest of the world than it does in the United States. So, there's certain things that play big in the rest of the world and don't here. So if you ever wonder, like, why are they doing swords and sandals movies and things like that don't do that big? They're doing Gladiator 2, right? That have a spotty track record in the US. It's because if you actually looked up what, like, any Hercules thing or whatever does, it does more than Troy probably, right? Troy, like, was not a hit in the United States, but probably does more business than you think around the rest of the world. So it's still a very high production budget. The production budgets are really high for a lot of these things. And that's a constant problem that we've talked about. Yeah. So,
yeah,
but that could
look at
break out.
1996. Now, this was the first time they made Twister, but $88 million.
Yeah, which,
was the
adjusted for
budget.
inflation and everything, these numbers are still
Close.
Yeah, but then try to adjust the box office to inflation. Can you really get that? I don't know. But it's probably the right time to do that kind of movie. We haven't seen so much of that recently, and it's a throwback to another time.
It is
That's
good.
the problem
that
with
they're doing all these different movies because it's all been Marvel characters and superhero movies. It's so saturated the past handful of years.
Well, this isn't a comparable for it, but Bad Boys is not way out of line with Twister. You're from about the same era in terms of when you created both franchises. Those stars were at their biggest about not long after Twister came out, to be honest, within 10 years of that, 5 years. And also, it's a different kind of movie. Different sensibilities and stuff. I haven't seen Twister, so it might be quite different from the original one, but it's not the kind of movie that had been put out as much. You had a lot more, Bad Boys was the action thing that there was lots more of back then. There's a lot more disaster movies back then than there are lately, because these things were in place they've been replaced kind of by superhero movies. You can look at the box office and see that superhero stuff has kind of crowded that out. It probably went from 5% of the box office being superhero to 20% or something. In some years, it might have been higher than 20%, which is, has crowded that out. And that's why I say the slate's weak. Some of me saying the slate's weak is that you have lesser superhero movies included, or not, or you don't have superhero movies because they got pushed, So, there was probably a time where, I don't know, that people really thought Madam Web was going to do that great, but there was a time where they thought it would do better than it did, right? And then it became like, oh, this isn't a big movie at all. The surest one, though, I would say, is Deadpool and Wolverine. That's your best bet. And remember, Wolverine, even though it wasn't a huge movie, he did do Logan, which was R-rated, and so this is a return from that, and then you have... It could set some. It won't set records because Passion of the Christ was R-rated, and The Matrix was R-rated. But aside from movies like that, it will do really, really well for an R-rated movie. It'll be up there in the charts of all time, like really doing well for an R-rated movie. It'll play more like a PG-13, I bet.
You've talked about movie theaters being the most interesting category in the market. Do you still feel that way? I mean, how do you...
I think the economics of the movie theater...
Marcus?
Yeah, I kind of disagree with people in that. I think that the movie theaters and all of that are actually better positioned for the future. The part I worry about is what you showed with that production budget. I worry about the economics of the movie studio business integrated with other things, about the decisions that they've been making fewer and fewer movies, making them at higher and higher production budgets, and exploiting them less in terms of giving them a long window at the box office so that there's lots of marketing support for it and everything. I think the economics of making a movie right now are not as good as they used to be. But the economics for movie studios are not bad. I mean, they already... What are we at in terms of what did Cinemark make in the last fiscal year, right? They weren't, in terms of operating profit, are they 2/3 of the way back to where they were?
Yeah, so last year, 2023, operating profit, $372 million. Let's go before 2020. I'll read it from 2017 to 2019. $430 million, $459 million, $407 million. So yeah, they're closing the distance for sure.
Yeah, and this is a stock that what was a $45 stock at its peak or something. I don't remember exactly what it was, but I think where it is compared to where it was versus say that for like a Disney or something.
Mm-hmm.
Yeah, it is more discounted, and the business I don't think has a worse future than you do for movie studios. I think movie studios, which are because they're part of bigger entertainment companies, I guess, because they have streaming things, I guess, are valued in the market more highly versus what their past was.
The business itself, too. I mean, the numbers should start to look better. There's momentum there. Business momentum.
The most important thing is they talk about, oh, we have these great loyalty programs and these amazing seats in our food and beverage and whatever, but those are small compared to the product that's being played in the theaters. That's what matters. And so they are at a very low point in terms of that. So even if we see numbers where we're down in box office this year from last year, not a surprise, because in terms of product, we're down even more. Given the easiest way to measure it, it's not perfect because you have reduced competition, but you ask, okay, if this movie came out at a different time, would this movie do better or worse? Yes, the overall box office is worse, but if we're not putting out the same number of movies that people want to see, is that the reason for it? And I think that's a better explanation for this year than things in the past, where we did see initially out of COVID, we did see family films not doing as well because they were all being put on streaming things. And I think people thought they would come back, that the lesser family films weren't doing that well. And stuff with romantic content wasn't doing that well. But I don't see much of any differences now. But I do see that the slate is really weak. And we talked about that. Yeah. We're in the part that had the best movies, basically. So that's the downside. I mean, the summer ends really... This happened last year, right? When did... we talked about this where I was like, basically the summer's over July 7th, July 15th, like in terms of things opening. A lot of the country doesn't go back until like the first week of September or something in terms of when the summer would actually be over for school and all that. Some go almost a month ahead of that. But that's a very short summer season if you're saying that it ends by the middle of July.
Interesting. Could transition over to markets a little bit. Just have this pulled up on Google Finance so people could see a visual. The S&P 500, this is the price index, is up 17% year to date. What do you think the Russell's up?
2? What's it up?
Yeah. 1.47%.
1.47, yeah. Small caps
pretty
are
crazy divergence,
basically
right?
flat. Yeah.
It's insane. The difference there.
It happened at the end of the 90s thing that I remember. So, like, that's the way I remember
up
it.
24% year to date.
Yeah, we talk about it as like a .com bubble, but it was technology, media, just big cap and well-known brand name. I mean, like, I'm sure GE had a high price multiple at the end there. Things that were small were very undervalued versus things that were large. It narrowed in terms of what people wanted to invest in, what they wanted to talk about all the time. So we have that with AI things now and the interest in that. And some of the stocks that are driving the prices higher are at very high price to sales ratios. So, but
Mag 7's up 48% year to date.
Right. And what did I say? I said, look, if you want to, if you want protection against the market going down or whatever, there's no other way to do it than like short the Mag 7 and buy what you want to buy and think how much you'd be down right now. But probably that will be when it breaks. What happens is the only way that people could get positive returns is that they own the stocks that they own, which is no Mag 7, and they're short the Mag 7. That will be the ones that would go up. Tesla isn't even down for the year anymore, and the results have been terrible. So, but so that's one of those things that, I get lots of emails about this. I was talking to someone about this very issue. Because if you're a professional money manager,
the divergence or what?
Well, you could get fired. So everyone owns.
You don't want to trail too much.
If the Mag, let's say Mag 7, not just Mag 7, but let's say these kinds of stocks or something are like a third almost of what your benchmark is or something, right? Then what you'll do is you'll own a sixth of it. Like you'll put a sixth of your portfolio into it, and that's as far as you'll go. You won't put nothing into it, right? And you could cherry pick which ones you want and which you don't. But actually that won't work that well, because at phases at the end of a boom, it's like things that are lower quality sometimes ascend faster than things that are higher quality, things that are more speculative. It actually, like, one thing is people always talk about the idea that they could pair trade things,
Yeah.
And that's fine. It's totally fine. But if your goal is like avoiding, well, it's not that hard to do if you're able to stay in it over a long period of time. Yes, there are discrepancies between you could do it, but it's not helping you versus value investing. Why they want to pair trade is because they don't like the regular kind of value investing that they're doing, right? And so they're saying, oh, I want to be able to make money in all markets and stuff. It'll actually exacerbate the problems, because at the end phase of a bubble, the things that should be going down, that are overpriced and have worse business performance in their future, will go up even more, and the things that are underpriced and have better business in their future might do even worse. So you could do even worse by trying to be long short in this kind of thing. I'm not saying there's anything wrong with doing long short. I'm just saying that people, what they imagine is it's a way to make money, because it's not like arbitrage or something. It's not some way that you could be making money consistently. It's still exposed to the same basic problem of what happens in a mania, So you might be saying, oh, NVIDIA is overpriced, Apple isn't. I want to be part of the Mag 7. I'll be long Apple and short NVIDIA. But then you're just exacerbating, because how's Apple doing versus NVIDIA or something? You're not really helping yourself, as opposed to if you just said, I'm not going to be in any of them. I'm just going to do my own thing.
I think NVIDIA is up about like 160% year to date. So you got Apple up 22%, and NVIDIA, 165.5.
Look, I don't know what will happen and everything, but what happens is it's very much a narrative based thing, right? So people overlook some of the things that they would normally. So like I said, look, don't buy stocks that are the price that high. Just don't do it. If you're over like 10 times sales and stuff, yes, if you had like a monopoly and no tangible assets and you're growing fast, could it make sense? Maybe. But you don't buy things at 20, 30, 40 times sales ever. You really shouldn't buy things at over 10 times sales. Your life would be better if you never touched anything in that range. Because even great companies will occasionally trade below that and you'd have a chance to buy them. I think I mentioned on podcast before, I believe all insiders in NVIDIA only sell, they don't buy ever, right? I mean, I don't think there's ever been, for a very long time, there hasn't been buying in NVIDIA. And then NVIDIA is like close to one of the biggest market cap things in the country and the world. Those as a group have a horrible record of things that that become the biggest. If you said, I want to be the most valuable company in the world, you don't want that, because your future record tends to be very bad. And even countries that end up having a lot of them, like you saw with Japan, they were suddenly on the list of all these big market cap companies. They did terribly after that. U.S. back in 2000, So same thing here. It's not a good sign if the U.S. has all the largest companies in the world, and it didn't not that long ago, because it's the market cap going up, right? So all the soft signs of the usual kind of anecdotal stuff of this is the kind of measures that say that you're overpriced in a bubble, all that, they're all flashing. But because someone asked about this, I said, the problem with this bubble, right, the AI bubble, is I talked about how incestuous it is that these companies buy from each other and are each other's customers and all that. But the really big thing is that these are capital investments, and they're extremely far away from the consumer. So it has, and these companies all have like incredible access to credit because they're huge companies that could issue stock. What will happen is their stock prices have to go down first. Their PE multiples have to collapse in some way. And then that can stop an AI bubble, not the other way around. As long as they're being rewarded for it as public companies, because these are all public companies that are making these investments, basically, it won't stop because there's nothing to stop it. Like if you had a video game boom, and they made way too many games for Atari. And then how did that end? Well, they couldn't sell them. So when they actually, they went to stores, and the store said, have to send them all back. We can't sell these things. You'll never know that. They'll keep investing in AI and investing, even if no one wants AI, right? So it's the perfect sort of thing for creating a big bubble that way. It's almost like it's defense spending or something. Like if there's a bubble happening in defense spending stuff, well, The only one that can shut off is the government stops spending on it, right? Like, it doesn't matter if people say we don't want more tanks. The government decides how many tanks there are. In this case, you have the Mag 7 type companies deciding how much to invest in AI. It doesn't really matter if something like ChatGPT or whatever is heavily used or not heavily used. That's not necessarily what's going to drive the investment. So it's a bubble that could go on for a long time, get very big. It reminds me more of the telecom aspect of the 90s bubble than anything else. It's not very, we're so far from the consumer with this stuff, you know? It's so speculative for the future that as long as people believe in it, it could keep happening for a while. So there's no way to sidestep it. You just would have to underperform. You know, if you don't own these things, you just have to underperform until it stops.
I keep thinking about it. Is this like year 2000 where growth dies, and I tweet about this, and capital rotates back to value, or is it more like 2002 where everything tanked no matter what you owned? Stocks went down simply because they were stocks.
I don't know. I mean, yeah, I don't know the answer to that. In fact, it's possible. I mean, it's already started when you think about it. The reverse of what you're saying about the first one. The bubble stuff is what's holding up the market. Like, if you look at the median, I mean, we look at like the Russell stuff, but if you look at the median stock below a certain level, it's not really done that well. I mean, you know, like the things that we invest in, you know, outside the S&P and everything, which is the vast majority of public companies, right? Like 90% of public companies are under the S&P 500. They're smaller than that. So the median performance of that is basically not up at all.
Yeah. Look at this chart right here. It compares the S&P 500 versus the S&P 500 equal weighted index, right? And this other chart too from the Daily Shot that was interesting. It says U.S. market 52-week lows have been outnumbering 52-week highs. It's so concentrated in those select few companies.
But none of this is a surprise to me, like, you know, because I'm not looking at what the S&P 500 is doing. I'm looking at all stocks and what things you might buy and stuff. Yeah, I would have said that that's what's happening. And has been for quite a bit, actually. This is not a super recent phenomena. This is a throughout much of this year thing. Yeah, it is interesting. There are still that has already calmed down a bit. Or I know there's some recent meme stock stuff going on, but it has definitely calmed down the non-professional investors, right? The retail stuff.
Yeah.
What is interesting is the extent to which institutional stuff is driving this. That is the part that's kind of fascinating. So I think that is way beyond. So from what I remember from the 90s to today, what I would say is the degree of speculative thinking among money managers is higher today, way higher than it was in the 90s. However, the extent to which finance is affecting the culture is less. So we are not seeing the same extent of the retail investor obsession of the 90s and just the cultural importance of it that way. There was a time in the midst of COVID where that was happening, right? But yeah, no, all standards of value and stuff that there were before, big institutions have moved on. But we've seen that already. There's a lot that let me own a little bit of Bitcoin or something, you know? So that's different. Yeah, there's an embrace by big institutions of some amount of speculative stuff. So
that's different.
Yeah. I mean, there was some, but if you go through, there's some.
Is it different because it works? If you've owned this stuff over the past 10, 15 years, really since the .com, you've done really well. Look at your Amazons, your Apples, your Microsofts. Microsoft took a little bit, but it's caught up.
Yeah, it's the same thing I'd say back in the 90s and stuff. Yeah, if we can all agree that we won't sell our stocks, we'll just buy them, then we can all get rich over time, as long as no one ever decides that they want to cheat on that. It's like a cartel, as you know. So yeah, you can trade with each other at higher and higher prices without any impact of the underlying value. You know, because when I was saying this, that someone was asking me about that, they were saying they don't see how the return on investment of the spending, because the capex is now really high at places like Amazon and Meta. It's incredibly high. They're becoming capital intensive businesses, and like the ROI that you'd be looking at there, you're saying, well, going out a few years, given this level of asset growth, and asset growth is usually a really bad sign at what future returns will be for stocks generally, is companies that grow assets rapidly tend to have bad returns afterward that. The ROI doesn't make sense. And my point was, well, the ROI calculation is like when I talked about WeWork, right? WeWork, the thing was, oh, well, here's how much my sales are. I get a multiple on that. It doesn't matter if I make money or not. I know how the market, in that case, private market, values me. They value me on sales. So all I have to do is look at this building. How much can I get in sales for it? And that's what matters. It doesn't matter if I make a profit. And I think that's the case here too. It was the case with streaming. The return on investment for public companies is how much their market cap goes up when they do these things. So they're getting great returns. Now, they're not returns that are earning them in cash somewhere and whatever. They're just great returns in terms of the market cap going up. Mm-hmm. Some of them are making really good money. NVIDIA, there's no doubt they're making amazing money. But to me, that is consistent with what happens when there's a total shortage of a commodity that you're producing. That's what NVIDIA's long-term record has always looked like. It's what it looks like now. And I think everyone agrees that there's an acute shortage of, there's way more demand to buy things. You can also see that just in pricing things, and you can compare things in inventory with things in sales and stuff and just see how strongly driven that is. But that's not a unique feature of it. It happened, during COVID. It could happen in old economy things, right? Mm-hmm. Like if there's just nothing in supply relative to what people want to buy. So, but I have, it will.
You talk about the cartel, right? You talk about the cartel and the difference between 2024 versus the 2000s. What if it's because passive flows and passive funds and indexing is basically how market participants invest mainly now, like these huge institutions, right? Because here's the thing, right? Mm. Think about how big all of these firms are nowadays. These funds, these pension funds and everything, they invest on like passively, right? And passive households or passive investing is like how people invest nowadays. I didn't include this in the chart, or in the presentation, but I do remember this because I was reading it. U.S. households and advisors are heavily allocated to stocks. So not only are we at like all-time highs, right? Mm-hmm. Households, it's among the highest levels in over 70 years. Mm-hmm. And same with asset managers, 98% fully invested.
Yeah. So this is a complicated question. Theoretically, what you're saying, it should not matter. I would argue against that in that you could have huge amounts of passive in a marketplace. You could have huge amounts of passive and it still should not matter theoretically. If what we're talking about, and this is where it gets complicated about what do we mean by passive and stuff, but if what we meant is that there's a market of all active participants like us, whether we're private individuals doing this or a fund like ours or accounts like ours, whatever, but that we're picking individual stocks and not investing ever in ETFs and things like that. And then the only other bucket is people putting money into Vanguard, like total market, whatever kind of thing. Totally the most generic passive thing that you could imagine, right? A true index fund, right? And not churning it. Then it shouldn't matter. It should be fine even if that goes to 80% or something, because that's essentially just noise. It wouldn't matter. And then the buying and selling is a signal. Where it could matter is if passive things are actually not that they're not, let's just buy the market, right? But we're counting things as passive that are actually not passive. They're actually a choice, a vehicle for making an active decision that's sold as passive things. Or, and this is very possible, that active investors mimic passive. They use it as a benchmark or something, you know what I mean? And then that would cause very serious problems if you have mimicry by active participants in a market to view the overall market as something that they need to keep up with. That's more of an issue. But if you're saying the existence of passive and active, if passive was huge, and as I described, and active was small, and you could blind them to each other, right? They didn't know what the other one was doing. You didn't know what your benchmark was or how you're doing. I don't see a problem with that. It could be hugely passive and the active investors could still work fine. It's the contamination of the passive into the active that has the potential to really mess things up, like I'm talking about. And I see that all the time because a lot of people allocate, of professional money managers, allocate a portion of their investments into stuff they don't really believe in. because they need to have a certain degree of matching up with a passive, which gets, weird and complicated because we're all saying, well, we have to not output. I mean, it's the reason why I'm against indexing. I'm totally against indexing. And it makes tons of sense in every way, but here's the problem. There's no common sense safety. There's nothing in indexing that promises you that you can't cause tremendous damage to clients, households, whatever, permanent loss of capital in a huge way because you are saying that it works. There's nothing to stop it from getting out of control, and it could reach that point sometime. It may never reach that point, but active always allows for an active way of managing risk. So you can just say, I won't buy over 10 times sales or something. Passive won't do that. If most of the company, I mean, you talked about the Russell or there's a lot of companies in that don't make any money and are bad credit risks, Now there's not in the S&P, but that's not being sorted out actively when you invest in that. And now with S&P type things, yeah, they're good companies, but some of the price to sales is not being sorted out. You can't assume that if you pay many, many times more for companies that they're still going to have similar stock returns in the future. So that's why I say no to passive. It probably works most of the time, but it's the danger of, which we may deal with at some point too with AI things. If there aren't certain safeties built into things, it could result in catastrophic failure of something that a human being would stop because they just have an aversion at some point to doing certain extremely high risk things. And there's no safety in place. There's no fail safe. The passive is a method that has zero fail safe. So it can get out of control, and it will at some point. And you could lose a lot of money. So that's why I'm against it. But yeah, most of the time it works fine, and it could work better than active.
Mm-hmm. I thought this chart was interesting from Monish Pabrai. Somebody had tweeted about this from one of his presentations. So he took the S&P 500 and he was overlaying like a valuation thing with it, right? So he says in September 2000, the S&P 500 traded at a quite frothy trailing price to earnings ratio of 25.6. For more than the next 11 years, the S&P 500 delivered zero returns inclusive of reinvested dividends. He says it was not a fun ride. So he took it from September of 2000 to October of 2011, 0% return. So basically, the higher multiple you pay, if things revert back to the mean, it could take a lot of time to get back above that prior peak. We've talked about that with Microsoft before many times on this podcast, how it took forever to get back above its prior peak. I mean, even with the business continuing to perform well and the fundamentals of the business performing well, the valuation, it took a long time for it to come back. Today, the S&P 500 trades at a trailing PE of 25.4, almost identical to its level in 2000 and significantly above its long-term average of 16. It is entirely possible that the S&P 500 continues its upward trajectory for the next few quarters before reverting to its long-term multiple. While S&P 500 has historically been a great choice for long-term compounding, buying into it at a trailing PE over 25 is likely to be a risky proposition.
Yeah, what happened in 2000, though, is, of course, there was a recession, right? It wasn't much of a recession, but people were expecting continuous growth. But you have that now in terms of, I was talking to someone who was sharing, which I don't normally look at, what analysts expect EPS growth to be this year, next year, the year after that. And that's amazing what they expect it to be.
Trader Geoff.
But I mean, they're expecting, it's close to 10% higher earnings per share growth than GDP growth, probably. I don't know what they have in for GDP growth, but GDP growth is probably extremely low over that time period. I don't think anyone has projections for strong GDP growth. So you have the unemployment rate here, so I'm sure we'll talk about this. But obviously there's signs of, possibility of a near-term recession. And
yields are basically pricing that in too, right? Softer employment services PMI data sent Treasury yields sharply lower, and people are starting to price in like rate cuts and stuff like that. Yeah,
I mean, inverted yield curve and rising unemployment are two of the strongest signals usually, and they're both at levels that are almost never a false signal. Could be. I mean, the issue with the inversion thing is that it's not a time till thing, so we could say, oh well, but tends to be that it does not on-invert without a recession happening. Now it can stay inverted for a long time. And unemployment, theoretically, I guess you could say, well, maybe it could start going down again really fast, and then we won't be at levels that have in past times always signaled a recession. But it would be odd normally for unemployment to rise by more than 0.5% and you not to have a recession. It would be odd to have an inverted yield curve and not have a recession. But there's just also other things that are indicative of recession that seem to be, at least.
Like what?
Well, so basically,
it feels like things are slowing down, right? Like I look at the S&P 500 being at all-time highs, but then I look out into the real world and the consumer, inflation, how people are feeling, where people are spending their money, where interest rates are. Housing has really come to a halt. Seems like things have really slowed down.
Yeah. I think if you live off of your earnings and you don't have a lot of net worth in your house and your stocks, you're in a recession right now. Like in terms of what we see in terms of credit things and all that, it looks like a recession. And in terms of what people are doing it with retail sales in those categories and stuff, right? But on the other hand, if you own a house, you own stocks, you have access to credit, you can decide, oh, I want to save more this year, or I want to spend more this year. You don't have this risk of your bank account being close to zero each month so that you have to spend what you make, basically. Then you have a lot more flexibility. So, and those are the people who invest in the stock market mostly. So they're feeling pretty good. But I think most people would be close to recession type conditions in terms of the consumer stuff.
So recession from the bottom up.
Yeah, but 2000, I mean, yeah. So 2000 could be driven more by business type things, right? So like you had to slow down in internet stuff, basically trickling back to everything else. Here you could have it the reverse way, where it's led by consumers and not by businesses. If you remember the COVID one, that was actually driven, you saw it in marketing, in ad spending, in CapEx things, in employment levels at tech companies. Those were pretty dramatic in terms of businesses slashing everything, but the consumer wasn't. The consumer didn't say, oh, I need to save because COVID's happening. Now, a big part of that is they were sent government things and all of that, or they thought they would get it soon. But they didn't husband their resources, but corporations did. And so this could be a reverse of that, where it's led by consumers. Yeah. But asset price stuff does have an effect on people's behavior. It doesn't have an effect on everyone's behavior, but some of it does. It's not true that it only affects rich people who own the assets. Those people then in turn spend and act in ways that then affect the earnings and everything of other people throughout the economy. So other things equal, high house prices, high stock prices do have some effect throughout the economy, even for people who do not themselves own stocks. They benefit in some ways from it.
Yeah, momentum. This is factor analysis for performance for the year. Momentum up 19%. Value down negative 2.7%.
Yeah, so that
year to date.
That part feels very end of the 2000s. Momentum and size, right? Like, what is it? Yeah, let's see. Growth, quality. Okay, yeah.
Does value ever outperform?
Yes, look a couple of years back.
2021, 2022. Yeah.
Yeah. I mean, it doesn't take a lot for it doesn't take a lot to outperform some of these things because of how much the decline can be that we saw. Like there was a period of a few months, maybe what was it, end of 2020? Let's see. I mean, so coming out of COVID, actually, when you had the vaccines and all that, and then maybe there was a few months before, but when that meme stuff all died down around then, you did have outperformance of value, honestly. You did, because you had pretty big drops, if you remember, in some speculative online type businesses at around that time. Do you remember buy now, buy now, pay later things? Okay, yeah.
Oh, yeah.
So some of those things, you'd be surprised how much they collapse. I mean, I'm sure Carvana's doing great now, but there was a point where it collapsed a lot. Even bigger things. I mean, I think PayPal was down a bunch at one point. So you can give back a lot of your gains pretty fast in those things when you have that kind of price.
Yeah.
If you're priced at very high price to sales, then you can give back a lot of it in the decline. And all value has to do is not really decline by all that much. not have down 50% years when some other things do sometimes have that.
Mm-hmm. Mm-hmm. The topic for today, as it kind of ties into all of this, we've talked a lot about this, but has value investing changed in your mind? A couple podcasts ago, you talked about some things that were different versus when you first started out, on like how information gets into the marketplace, and sometimes management can be telling you a certain thing, but because it doesn't show up into the numbers, it may not be reflected in the stock price. So I'm just kind of curious to hear your thoughts about if there's been a difference between like mispricings and how those mispricings get realized in the markets and how that has changed. It's interesting. You look at a lot of Buffett's stock purchases, and it seems like a lot of them have sort of had a macro bent to them, sort of, right? So you have Occidental Petroleum, right, tied to oil. And I mean, we spoke about in here that you think that he thinks oil prices are going to be higher in the future. And then, of course, those size constraints, what else can he buy and stuff like that. You talk about him with the Japanese trading houses. You talk about his trades, his investments in airlines, right? It was more of like a segment situation. So do you think value investing has sort of changed? Does it all tie back to Monish's slide that we spoke about, that, things are just so frothy and the forward returns historically when buying something at a market PE of 26 they don't stack up well with history? What has changed in your mind, and just how you even approach value investing, if anything at all? I mean, yes, we understand that all value investing is intelligent investing. Buying something for less than what it's worth is a great way to make money. But I do wonder if buying a high quality company at a fair price, has that changed because you're not getting those fair prices anymore? Or is there just a new definition?
Well, the first thing I'd say about the value investing is, look, any strategy, whether value investing or anything else, if you're not willing to materially underperform the market for 3 consecutive years, then it's probably not a strategy that will work. And you can't expect it to do that. So, like, I believe markets are efficient in the sense that when you ask, can you consistently outperform doing something? No. I mean, you can in like some of the things that Ed Thorpe did and everything, but then those eventually get taken out. They're pretty simple to figure out how to get rid of them and trade them away. The things that are more common sense things that pay off over time will have long periods in which they underperform. I think you talk about the information things and stuff like that. I mean, the big thing that's changed is it is more, everyone's thinking is more complex, and there's less common sense thinking, definitely, and less active research by a human being than there used to be. Value investing is very quantitatively driven, and everyone believes in factors and quantitative things and all of that to a greater extent than they did 20 years ago. When I started investing, value investors did seem to be much more a different bunch of people than they are now in terms of what they thought mattered. And they did have a more trust in their own common sense decisions about things. Yes, you said those were macro bets that Buffett made, but like some of that is common sense things. It's not worrying about the macro. Yeah, the Japanese trading companies did look cheap, and he laid it out. He said, look, they're doing better things for their shareholders than American companies are. They're awfully similar looking to American companies, and they're cheaper than them. So doesn't it make sense to have something that has a low price to book and is doing things to improve? Doesn't that always make sense to buy them? That's what he did back in the, like when he bought, when he first bought Berkshire Hathaway, it was closing mills and buying back its stock. So it was a pretty terrible business as a net, but its capital allocation was actually looking like it was going to do something, and it was really cheap. And so that's the kind of thing he did with those. It's true, you could say with the oil bet, right, that's macro. But on the other hand, it's also could just be accepting that, look, at some point, yes, it's an oil company, but it looks better on all the measures that I can see than other things that I could buy. And so it may, in some sense, be just accepting, not looking at the macro portion and saying, okay, what do I know that the price is overpriced? I'd see it more as that. Like, unless you can prove that the oil prices are too high versus what it'll be in the future, it does look more attractive than other things. We own some oil things and stuff related to that for that very reason. It just, I'm not attracted to that area so much, but I'm willing to buy it if it's very hard to prove that you shouldn't, So yeah, I think that a lot of those, I do think that things have changed. Sure.
I do remember a podcast David Einhorn did where he was speaking about he no longer will buy, let's say, a company at 10 times earnings and expect it just to re-rate to 20 times earnings by itself. If he's going to buy something at 10 times earnings, he wants the company to be buying back like 2 or 3% of their float, something every single year, where it's like if you underwrite it over 5 years or 10 years, that float is going to get smaller over time. Like something is going to happen here. Do you agree with that? Has that changed?
No, I don't agree with that. I think people change and they adopt what he did, and I think it would be natural for me to adopt the way he did. He underperformed for a long time while being a public money manager, and so eventually you adopt that, and I think most people become worse over time because they change from the thinking that got them success when they were early on in their investing. We do have to remember that the best record of whether we're talking about Pabrai or about David Einhorn or whatever was probably in years when we weren't listening to what they were saying. And now in later years where the record may be very good, but it's not as good as it was, that got them famous, we are listening to what they say. Buffett said that, I think he's quoted saying that in Snowball. He said, I probably had my best ideas and stuff in the 1950s when no one would listen to me. And now everyone gathers around to listen to me when I have a few good ideas left, So I do think yeah. Yeah. I mean, you get beat. I mean, most people would have quit, David Einhorn didn't. But most people in a situation would have simply quit. And so you have to adopt things like that. I think Pabrai changed concentration levels, to some extent also due to that happening.
He was more concentrated, right, before?
Yeah. I don't know. To me, it's kind of like saying, you underwrote a bunch of things then there was a hurricane, and then you change how you underwrote after the hurricane. There was always going to be that. I mean...
that chance, yeah.
Not just that chance, it will happen.
Yeah.
You should expect that there will be a bubble, and you should expect that the bubble in your lifetime, and the bubble will be worse than any bubble you've ever seen before. Just as if you shouldn't assume that the benchmark for what's the worst earthquake that could happen in Los Angeles is the worst one that happened before. They always, in presentations show, here's how well we'll predict we'd be in the worst case scenario of that. But the future is not the worst case scenario of what happened in the past. Each one in the past that set a record. In 1929, they said no one could have imagined a bubble like that happening. And then it happened. And then I guess in the 1960s, you could say, oh, well, at least it's not as bad. It's only about as bad as the 20s, or it's not as bad as the 20s or whatever. Okay, so you were fine then. But then the 90s exceeded that. And Japan had already exceeded the 20s bubble 10 years before that. And then we had the housing bubble. And people said, oh, you can't have a bubble in housing. And now we're at levels, if you look at the Shiller PE and everything, we're at levels that really rival. I mean, they rival most any bubble. I mean, yeah.
Current Shiller PE ratio, 36 times.
Yeah.
And the median is 16.
Yeah. So, look, I mean, yeah, do I think we're in a bubble and that there could be big losses in the future and all of that? Yeah, of course, because... the main indication of that is just a total lack of, caution. Buffett has a good quote about that, basically, and it's very, very true, because I think it's even better than knowing the fear and greed and stuff, is how cautious you have to be is, in a lot of things in life, is very dependent on how cautious other people, the conventional wisdom and stuff, is being. It's pretty safe to be pretty reckless in areas of that you're dealing in which there is strong caution by everyone else around you. Then it's not that important what you're doing. But in areas in which people are taking risks and don't realize they're doing it, you have to be super careful about it. And mostly the places where we lose money or make mistakes, whatever, honestly, are situations in which we are aware of the risks, are more aware of them than other people, and yet do not act on them sufficiently because we take comfort in the fact that we are much more cautious than other people are, but still not cautious enough. And that's a mistake. And, and the reverse is true too. But at the point at which everyone is fearful and doesn't want to do anything, that's when you should be doing things. But, now is a very, very unsafe time to be investing. It's a very unsafe time to be passively investing, because that passive stuff incorporates the fact that no one's taking any caution to anything. Passive is just piggybacking on that. So if people are really disciplined and you invest in passively, that's fine because you're piggybacking on the wisdom of other people that way. But if people are behaving in a way that has no wisdom in terms of risks, and my feeling on it always is it's risk habituation. If people go long enough, they will adjust to anything.
Sure.
You ask them what tax rates should be. If their tax rates have never been above 4% on personal income things, they'll tell you an 8% tax rate would be outrageous. If you raise it to 90% and keep it there for a couple of decades, they'll say 50% sounds really fair. It's just whatever they're used to in the recent past, And that, we saw that with interest rates, right? Where people just thought they couldn't re-rate to something else. They did. And we see that with stock things now. I mean, when I did a study of this kind of stuff using Shiller PE type thinking back before the bubble, the housing stuff burst. So when I did that, I did say that, look, stocks and whatever it was, that's the December 2006 or something, probably is when I started those, are too high priced. Stocks are overpriced, right? But it's also the case that they've been underpriced throughout history, right? So if you look at that Shiller PE chart, I would argue that pre-1996, let's say, if we take the whole history of that stuff from 1996 before, on average, they were too cheap. There's not a good reason why just being in stocks generally should give you so much better returns than if you were in bonds and real estate and whatever things that, there's this very simple way to make a lot of money by just being in kind of randomly buying the stocks and then holding onto them for long-term did really well. But since then, we've been pretty pricey. Like there was a blip that was down, but if you look on average, we've been at higher levels for much of the last few decades than we had before.
Mm-hmm. Mm-hmm.
And we can pretend that's not true, but it is true. And it's not unique to the Shiller PE. We can use the Shiller PE and people complain about that method, but it would show up in sales, book, whatever. It shows up on everything. So it's just the P part of it. It's not the E part of it, how you're measuring it. So it has nothing to do with the Shiller PE as a method of measurement. It just gives us an easier graph to look at because the others we have to talk more about what's happening in the graph. So yeah, I mean, I think that, obviously there's very high risks that we could have large losses in the future. That's concerning. That we could go long periods of time without good returns. Yes. But I also have no basis on which to be able to predict when it'll happen and how you can avoid it. I think it's pretty unrealistic to believe you can participate to some extent in it now and minimize your underperformance. And you can also sidestep what will happen to everyone else. Mm-hmm. You got to pick one or the other,
Mm-hmm. Mm-hmm. This is getting pretty technical here, but in that the Daily Shot archive that came out today, they were talking about the implied volatility of the market is basically at the levels it was in 2020 before the market tanked. So basically, they're pricing in no risk, basically, going forward, which I always like to watch, implied volatility levels, only because they start to price in risks, and sometimes you can, if no risk is being priced in and all of a sudden something happens, spreads will blow out, options will blow out, and you can make a lot of money. There's a lot of leverage in that.
Mm-hmm. Yeah, I mean, I think that's probably useful as a short-term measure,
Yeah, not over a 5-year period, but year to year or whatever. It's just interesting to see what what's being priced in. I mean, same thing with the futures curve, right, or the yield curve, just seeing what people are pricing in for the future. And how wrong that can be. We came into 2024 with 6 rate cuts or something like that, and that hasn't happened. Now they're talking about 2 between now and the end of the year. But market just has kind of shouldered off any sort of downside from that.
Yeah, I mean, my feeling is basically the price is all that you need to look at as a long-term investor, because on average you're going to be saving more. There's some people this might not be true for, but you're going to be saving more than not. You're going to be owning things for longer term. So you can try to get in and out of something, but for us and others like that, it would have to be something where you get out of one part of the market and into another or something like that. You know what I mean? We can't really look at, what's the likely future in terms of the next few years? Is there going to be a recession? Well, the recession will probably affect all your stocks. So I think just to be realistic about how much money you're going to need for retirement and all that, probably a lot, because what you're looking at now is vastly overstating what it's worth. I mean, you can just look through at the earnings and you're not earning a lot. The actual stocks you own aren't earning all that much, but you're counting the price that they have as being really high, you know?
S&P 500 earnings yield 3.4%.
Yeah. So, and obviously you now have higher interest rates and higher inflation too. So when comped against those things, like what you should be comping that against is, say, a bond or something, you know, it would make sense, you know, to use like EP ratio basically versus something like a long-term bond that has, you know, I'd say like, investment grade corporate bond or something. You know, people use government bonds, but those can be distorted a bit more in terms of realism. Would you really put your money in government bonds forever? That seems excessively risk-free to be comping against. I think more realistically is like an investor deciding between would I be in corporate bonds or would I be in stocks or something. I don't know that stocks will outperform corporate bonds, for instance.
So when these people are reaching out to you, are they saying that they do own a piece of Mag 7, like NVIDIA, for a portion of it because they just have to own it, or what?
Yeah, I mean, it depends. So if it's a professional money manager, sure, that's possible. If not, then no. The general sense of all the emails that I get is things are really expensive. Mm-hmm. You know, but I have to buy things or I have to do things, and you know, what do I do? And just a general sense of confusion. I don't understand why the market's behaving the way it is. Have I lost touch with it? You know, there's that great part where Buffett's wrapping up the partnership and talks about that. And he's at that time, I guess he was 35, 36, something like that. You know, so I'm 38 now. And he talks about being an old man out of touch with what the market's doing and all of that, and saying that he can't really participate in that. Right. And you can keep investing, but you do have to make the decision whether you should be participating in games that you don't understand and that don't make sense to you. It doesn't make much sense to me to invest in things that have really high price to sales, don't make any money, whatever. I mean, we've gone through so many stocks where there's lots of stocks that are up a lot that don't have any earnings and don't necessarily have a lot of potential to have earnings that we've looked at. And they've worked. So, you know, those things do work. I mean, if value investing worked all the time, people would just do it all the time.
Of course. Mm-hmm.
It's got to, and also value
There's
investing.
There's only one strategy in the market that does, and that's Renaissance Technologies.
Yeah. I mean, the other thing is value investing for the most part doesn't have like these huge catastrophic drawdowns, you know, compared to other things. So it's got, what else would make up for that except long periods of underperformance? You know what I mean? Like, I could believe in a strategy would work that is overall really successful. Like, say, you know, if you own, I don't know if this is true of like literally Netflix, but Netflix is probably a good example of a stock that sounds like this would be true. If you owned it for a long time, you probably made a lot of money, but there's got to be a lot of points where it dropped by more than 50%, right? And so that makes sense. Why is it outperformed? Because people don't like that to happen. So I totally get why that it would exist in the market, that there's a way to make a lot of money in something that drops a lot frequently. Value investing, if you don't like dropping 50% or something as a strategy, then you otherwise have to deal with underperformance. I don't have something for people that consistently outperforms, doesn't have a giant drawdown, and, you know, like...
Yeah. This is just, this is funny to me. Like, so the peak was October 2021. And this is when they had that bad earnings. And the reason I remember this is because I think Pershing just like recently invested in them, and then they dumped the stock like aftermarket basically, which, you know, because I think Netflix was going into advertising and it was just different than what they thought the future would be for the company. So instead of having some thesis drift, right, they just got out of the stock. But so it crashes from, you know, 690 down to, let's say, high 100s, low 200s. But, you know, here you are a couple years later and you're right back to the peak.
And some of that was a shift, as I remember, from the subscriber, basically even a shift in the shareholder base and the narrative of it, which was that it was all based on these having higher and higher subscriber numbers. And then Netflix basically said, we're not going to focus on that anymore. I think they're going to stop reporting some of that stuff. So they had to kind of reorient people to the idea of it's about our profits and our free cash flow and all of that, and not chasing higher subscriber numbers, at least in the United States, all the time, because that was definitely going to go away. That became saturated by then, yeah. But I mean,
narrative follows price.
Yeah, if you were not a stock investor and you're just using Netflix and know people and all of that, what changes would you have seen? What you know? It can be pretty dramatic. There, in terms of the difference between the business, you would have thought that Netflix was the dominant streaming thing that everyone in America used. And you would have thought that years before that drop that you see, and years after that. Yeah, I think. But we talked about that with Meta too. It had a similar drop, and that was, it had bad results for a year, sort of. You certainly total lack of growth and everything, but that was probably built into more like things getting even worse with. What could happen with TikTok and all those things.
The narrative changed so much. I mean, here's the thing that's challenging about value investing, right? So in 2021, so August 2021, right, was the peak. We'll call it like high 350s. And then the stock bottomed at $95, right? I mean, this stock, I'm pretty sure, was cheap, though, at $200, $150, right? So let's say, as an investor, fund manager, whatever, you make Meta a 20% position at $200. Well, that wasn't the bottom, right? And it fell by another, let's say, 50%. So that doesn't look so good on paper, which if you're able as an investor, everyone listening, because you don't have to answer to anyone other than yourself, right? That could be a great opportunity. But you think about like the psychological damage that could do on you. Your head could play games with you. The narrative's changing. Oh my gosh, it's the end of this. TikTok is different. I just think you need some business momentum to change things around, right? That's when they stopped the AI capex as much as they were doing. They did a huge buyback, and things started to really change around. I think Mark Zuckerberg started lifting weights, and doing jiu-jitsu. But yeah, I mean, the floor for Meta, you could have said, oh, it's cheap at $200, but then it falls to $100. That's a challenge for some people.
But that's life. I mean, the Buffett bought the Washington Post. It probably went down by a similar amount after he bought it to what happened with Meta, and then it turned around. I think what I'm saying is I think valuation obviously is very important, but sometimes I don't know if it's the floor. I think you need the business. No, it's not the floor. It has nothing to do with
some sort of inflection in the company. Be like, okay, things are turning around. Let's turn these machines back on to start buying this company.
No, if you only want to be in stocks when they're going up, you need to be a momentum investor and have stop losses. Now, you won't do well over time, but you will spend much of your time in stocks that are going up. Now, when we average it all out of what your costs are and how little you go up because of how much you're selling things because the momentum drifted off and so you don't stay in them, you're not going to do that well. But you will get to see a lot of green arrows by doing that strategy, But other strategies that work too, say you're a Phil Fisher investor or something, you have this problem. What happened to Meta? He looks at it, he researches and everything. You'd say, oh no, I believe that it's fine and they're going to recover from this, Netflix and everything. But you have this huge thing while the narrative changes on that. Every strategy would have this kind of problem. It would just be different. To a growth investor, the thing would be, what happened? Just people changed how they're thinking about the company and I suddenly lost 50% of my money, right? How do I know at what point it's going to change in terms of the narrative, right? Value investors would say, oh, I bought in a really low valuation and got even cheaper, But a growth investor would say, oh, I bought into this great company. It continued to be a great company, but for some reason people said bad things about it for a while. People's perceptions of it changed, but mine didn't,
I just think from has value investing changed, or the way that I think about value investing is that there's some companies that were cheap when I got into investing and they're still cheap today.
Yeah.
Right.
Of course.
So I just don't think valuation is the floor for it. I think you need some sort of business momentum or something in the business that's changing where it's like, okay, it's cheap, but things actually look clear skies ahead, Yeah.
I mean, there's lots of, look, both growth
I mean, if you're going
companies
to hold
and
some, if you have the benefit to hold something for 10 years, great. But if you have investors, you don't.
most stocks over time don't do well. It's just the way that it is, whether growth or value. So that's just what it is. I mean, the markets will outperform most stocks over time because just the math of it is going to be that most public companies over their entire record isn't very good. Sort of an 80-20 type thing. Much of the returns come to those things that are best that way. And the median result isn't that impressive. So yeah, if you buy indiscriminately in terms of what you're buying, yeah, it's true that it doesn't, it absolutely does not, it could stay cheap. But on the other hand, there's lots of things that I knew that people don't believe were once cheap because they re-rated and never became cheap again too. Mm-hmm. So, when you have the bucket of the value thing, there's value things that were as cheap, 10 times earnings or less or something at the same time as other ones. And then those other ones went to only trade at 20 to 50 times earnings for the rest of decades afterwards. They just re-rated and never became value stocks again. And then there's ones that repeatedly become value stocks, Mm-hmm. So no, but I don't think we've ever said on this podcast that just buying something on a price basis makes sense. And I think that the important thing, and this is why I like QuickFS and we use it and everything, but is a problem when we do these, is that's not really what matters. What matters the most is not the exact price that you're paying for something, but whether you're getting a good deal in terms of what you're paying versus the quality of the business. Right. Mm-hmm. And the durability of the business, of course. So when we're talking about this, where we do like, let's say we talk about Dollar General, right? So like if it has durability and everything for the long term, if you buy it at a low enough price, then you're fine. But if something is fundamentally and permanently wrong with that, then it won't work out, So you'll have a drawdown either way because of this change in people's attitudes about it, sure. But the question is really whether it's something that will have problems for the long term or not. I mean, but it's hard to tell that always. Best Buy would have turned out good as a value stock because it recovered from that, had a great turnaround. Bed Bath & Beyond would have gone to zero or whatever, or a GameStop, or that became a meme thing, but same sort of thing. Would it have been possible to tell ahead of time? You have to do both of those judgments on it, right? Mm-hmm. And that's where I say about the common sense thing. That's the part that I see missing the most, right? Whether it's value, that's the thing I see missing the most compared to what it used to be, is that people, buy somewhat on the metrics of what it is rather than saying, could this thing really be worth, what does common sense tell them about what it's likely to be worth or not, Mm-hmm. And that's why when we talk about things, sometimes they lay out like supermarkets and things like that, there's not as much question about what that is worth in the long run as if it's some other kinds of businesses. Like we could agree that maybe whether it has a really bright future or not, but if it looks cheap on earnings and assets and everything, then people can kind of envision what they see the future to be. Same thing when we talk about car dealers or, we shouldn't have as much questions about that. I get a lot from people that are highly competitive businesses, and I just don't have a good answer for that. There's some fashion-driven retail thing, and my answer is kind of like, I would need to know that. Like people who know that will know it could be worth a ton, but it can also go to zero, and there's nothing here to stop it from doing that.
Yeah. Cool. Well, any final thoughts on value investing in 2024, Geoff?
Yeah, I mean, I don't think that things have changed nearly as much as just people don't like losing every day. And so I think that it just affects them psychologically, but that's life,
Uh-huh. It's a great outlook, Geoff. That's life. Cool. Well, I want to thank everybody so much for tuning in with the both of us on the Focus Compounding Podcast. I need your questions that we will put in the presentation and pull them as a segment. I want to pull like 1 or 2 questions per show. So email them to me at andrew@focuscompounding.com. Do me a favor and keep them as short as possible, right? If you're going to send me like a page long email, I will appreciate it. Thank you for doing that. But it's hard to summarize that for the presentation to bring it up on the podcast. So if you have questions and you would like it to be answered in real time on the show, because Geoff doesn't get to see them beforehand, I do. email them to me at andrew@focusedcompounding.com. I want to thank everybody so much for tuning in with the both of us. Be sure to hit the subscribe button. If you're interested in learning about our money management services, you can reach out to me at andrew@focusedcompounding.com. And that's it. So we will see you in the next podcast. Thank you so much for tuning in, and we will see you next week. Take care.